Uber is much more than just a new age taxi. They're a worldwide network for transportation services, and not just the transportation of people, where they are tops in the world. They rank #2 in the world in the delivery market, right behind DoorDash. And to my surprise, they also compete in the freight market. I bet you didn't know that. They connect buyers and sellers on their network and charge a fee on every single transaction for doing so. In other words, Uber is a toll booth company, kind of like Visa and Mastercard. The annualized run rate of bookings on their network was $164 billion, and on average, they took a 27% cut. You heard me right, 27%. The credit card companies only take a 3 to 5% cut. This is why my jaw dropped when I started researching Uber. The opportunity is massive. They're #1 in a rapidly growing market, and they're constantly looking for new ways to expand their network into unrelated markets. But Uber's biggest opportunity is by far the hosting of autonomous vehicles, or AVs, on their platform. Actually, they're already there with their partnerships with Google's Waymo, Aurora, WeRide, and AV-Ride, to name a few. And a lot more could be hosted with Uber in the future. Who wouldn't want to be on the world's biggest transportation platform if transportation is what you sell? That's the upside with this company. It could be a 5x or more over the next 10 years. That's the potential upside, but Uber faces many significant challenges. They're going to be tested by some really successful companies like Google, Lyft, Tesla, DiDi, and all the other AV companies that want to take the lead in the AV market. We'll address all of this later in this video, so I encourage you to watch the entire video because it's very important you understand their strategy with AVs if you're looking to invest in Uber. The opportunity here is massive if they can execute their plan. Uber's moat comes from their first mover advantage and consists of a network effect and intangible assets. The network effect comes from the fact that as more and more and more people and businesses use their platform, the incentives for drivers to join the network increases because of lower acquisition costs and higher driver utilization. With more users on the network, drivers can easily find their next customer without having to drive long distances or wait a long time to do so. This increases their utilization and lowers customer acquisition costs, which supports higher revenues and profitability of the drivers. The network effect is completed because the more drivers there are, the shorter the wait times there will be, which attracts more riders, which increases the profitability of the drivers, resulting in more drivers and a shorter wait time for riders, and the self-reinforcing cycle takes off, creating more and more value for all participants. This network effect also applies to the delivery side of the business for the same reasons and with the same effect. But that's not it. Their app creates an intangible asset advantage as well. Just like any app or platform these days, Uber's collecting massive amounts of data on their users' behavior, which they use to optimize their offerings and algorithms, making their app and network a one-stop shop for all transportation needs. The effectiveness of their algorithms will lead to better customer satisfaction and driver utilization, further increasing the desirability of their network. Uber makes money through 3 sources: transaction fees, subscriptions, and advertising. Revenues have been increasing around 25% per year since its IPO, but this has slowed into the mid-teens over the past couple of years as the business has gotten bigger and bigger. Morningstar uses a 14% compound annual growth rate over the next 10 years in their fair value calculation. They have 161 million monthly active users that generated 2.9 billion trips in Q3 2024 alone. That's billion with a B. That translates into 11.5 billion trips on an annualized basis, which is just mind-boggling to think of. Free cash flows are fairly strong with a 19% free cash flow margin. I'd prefer that it be up in the 25% range, which I think is likely over the next 10 years, but this is what I really like seeing. They've been free cash flow positive in each of the last 7 quarters and 9 out of the last 10. And they've done a great job controlling their stock-based compensation. The percentage of free cash flow eaten up by SBC is rapidly declining as free cash flow has jumped and SBC has decreased slightly. We see a similar yet much more volatile trend with their per-share metrics. The per-share metrics aren't as good because Uber is increasing its share count at a 5% clip each year, which is acceptable at this stage in their development. Given their robust free cash flow generation, I expect to see a leveling off and even possibly a slight reduction within the next next 5 years, provided the bull case for this company continues to play out. They don't pay a dividend either, which I don't expect to see anytime soon, so the shareholder distributions are quite poor with this company. But like I mentioned earlier, that's to be expected given that they are a young tech company. Profitability has also been positive and expanding over the past 6 quarters. Return on invested capital came in at about 12% in Q3 2024, which means they're growing value for their investors given that their cost of capital is about 8%. Operating margins are 9% and look good given the increasing trend over the past 6 quarters. Morningstar expects 14% operating margins by 2028. Net margins have been more volatile due to a bunch of debt and equity investments they've made into their partners and competitors. These are mostly unrealized gains and losses for which Uber is required to revalue their positions each quarter, creating potentially significant volatility in their net income. For example, they took a $7 billion write-down on their investments in 2022. They would have reported a net loss of $2 billion that year, but instead they reported a $9 billion loss. They followed that up by recognizing a $1 billion increase in the value of these investments in 2023, which took what would have been a $1 billion profit and turned it into a $2 billion profit. Because of this, it's better to remove this noise, in my opinion, by paying attention to the operating profits when trying to gauge the health of their actual business. Of course, you must be aware of these investments and understand that, so far, they've lost quite a bit of money with them, and they could lose even more in the future, which will affect their net income, earnings per share, and net margins. And this right here is why Uber has my interest at the moment. They've dropped 13% over the last 3 months, which has driven their valuation down to very attractive levels. They trade at a 20 PE, 3 times sales, and a 3% free cash flow yield. Given their expected growth rates, this company is cheap relative to pretty much any young, high-growth tech company out there. But this may be for a good reason. Uber comes with a lot of risks, and one huge one in particular. We all know that AVs are the future of ride-hailing. Surprisingly, Uber made a huge pivot on its AV strategy when it sold off its AV unit to a competitor in 2020, after years of mishaps and even a death at the hands of an Uber vehicle. They shifted their focus toward becoming a dominant network for hosting AVs rather than competing in the hardware, software development of AV technology. On the surface, this isn't such a bad move. This strategy aligns with Uber's core competency of operating a global transportation network, where they can leverage their scale, brand name, and operational expertise, and it significantly reduces the costs of maintaining and growing its network because they don't have to spend billions of dollars on R&D and fleet management. They decided to go all in on establishing relationships with the AV technology companies like Google, Aurora, Didi, and others to become the platform of choice for hosting AVs. But here's the problem. As it currently stands, the ride-hailing and delivery markets lack significant switching costs. Think about it. There's literally no cost to downloading the Lyft app and getting a ride through their network if Uber wait times are too high, their service starts to degrade, the prices are too high, or whatever. And when you have a network effect without significant switching costs, the feedback loop can quickly reverse itself, leading to the destruction of the network. For example, let's say that Google is successful in rolling out its own AVs on its own network, which it is currently doing. The concern for investors is that this is likely to give Google a cost advantage for a variety of reasons. With a cost advantage, Google can offer rides and deliveries at lower prices than Uber can, and the lack of any meaningful switching costs means that it's likely that Uber's customers will choose to move to Google, thereby destroying Uber's network effect. The next risk is changes in the regulatory landscape. This is where the push for Uber's independent contractors to become employees comes in. If this were to take place, Uber's costs would skyrocket, eating into their profitability. Next, the rideshare industry and Uber's network is characterized by intense competition and rapid, relentless innovation. If they don't keep on the forefront of what is possible, then they will watch their competitive advantages break down over time. And lastly, it's not enough just to keep up with the most recent technology. They have to execute nearly perfectly at the same time. So what does all this mean for an investment in Uber? It really depends on your time frame. If you're just looking to take advantage of the dip by holding it for less than a year, then yes, I think it's a great price to take that bet. And for what it's worth, Morningstar puts a $79 fair value estimate on them, while CFRA values them at $65, and I value them at $81, but with a 30% margin of safety, I'd only be willing to pay $57. I'm a long-term investor that establishes a position in a company with the expectation of holding it for at least 5 years and ideally forever. And given the big risk of AVs to Uber's network over that longer time frame, I'm not willing to budge on my 30% margin of safety. I'm going to sit this one out until it hits my $57 price target. Well, that'll do it. I'd love to hear your thoughts on Uber or any other companies competing with them in the transportation or AV markets. Do you agree? Disagree? Are you buying Uber right here? Also, please make sure you like this video and subscribe to my channel so you don't miss any videos when I release them. It's a quick and free way you can help me grow this channel if you find this content valuable. Lastly, if you're interested in other high quality companies that could be good buys right now, click one of the thumbnails that you see on your screen. Until next time, you all take care. I'll see you in the next one.